Subject Specialist. Welcome to this A-Star Explainer. I am your subject specialist, and I'm super excited to be joined today by our senior examiner to really crack the code on IGCSE Accounting 0452.
Thanks for having me. Look, my ultimate goal today is to elevate you from just doing mere data entry to performing elite financial analysis. We're zeroing in on limited companies, diving into the strategic choices between shares and debentures, and breaking down exactly what it takes to secure those top marks.
So here's our roadmap for today. 1. Core conceptual architecture. 2. Technical execution. 3. AO3 interpretation. And 4. Critical examiner insights. Let's get right into it.
All right, Section 1, Core Conceptual Architecture. Okay, so for the 2026 syllabus, and this is especially crucial as we look ahead to the 2028 to 2030 updates, Cambridge demands absolute 100% accuracy with modern international terminology. The days of using legacy terms are completely over. You've got to permanently switch to using irrecoverable debts instead of bad debts, and owner's equity instead of just capital.
I literally cannot stress this enough. When I'm marking papers, seeing outdated vocabulary is an instant red flag. It immediately tells the examiner that you just aren't operating at the highest level of current accounting standards. This isn't optional. It's a mandatory architectural requirement.
Right, and that brings us to the prudence concept, which is honestly the beating heart of financial integrity. Violating prudence by ignoring potential losses, that overstates your profits and immediately derails your entire accounting equation. Think of prudence kind of like packing a parachute. You really hope you won't crash, but you absolutely must prepare for the worst.
Exactly. And if we look at modern industry applications, AI-driven accounting software, like Xero, for example, is actually programmed to mathematically enforce this exact concept. It automatically flags potential irrecoverable debts to make sure the business never ever paints a falsely optimistic picture to its shareholders.
So, to provide that exact same level of transparency for banks, owners, and tax authorities, you've got to master defining and applying specific paper 2 vocabulary. We're talking accrued, prepaid, realization, consistency, and duality. Senior examiner and duality? That is so often the stumbling block. It basically means understanding that every single transaction has a double effect. Say a limited company issues new debentures. Sure, cash goes up, but guess what? So do non-current liabilities. If you miss one side of that duality, your balance sheet is never going to balance. Period.
Moving right along, let's hit Section 2, Technical Execution.
Because knowing the theory is really only step 1. Step 2 is flawlessly navigating the procedural flow under intense time pressure. You start by identifying the source document, then move to the books of prime entry, post that to your T accounts, extract a trial balance, and finally, draft those financial statements.
Yes, and to help you lock in this exact sequence during a stressful exam, or, when you're carefully documenting evidence for your coursework, use this quick memory hack. Smart professionals track the finances. Source, prime, T accounts, trial, financials. It works every time.
Let's talk about advanced technical methodology. Imagine a student completely panics because they hit the wrong button on their calculator during a really complex, multi-step depreciation adjustment. Their final balance is totally wrong. Is their grade just ruined? Actually, no. Not if they showed their workings. We award what we call method marks for visible logic. If you explicitly write out the formula and show us your logical, step-by-step methodology, examiners are going to reward you. You can literally save your grade just by making your thought process visible on the page. Speaking of grades, in my examiner reports, I constantly see candidates bleeding easy marks by confusing the percentages for trade discounts with cash discounts. You have to remember, trade discounts happen before the invoice is finalized, right? Cash discounts happen much later, at payment. Oh, and missing state symbols or formatting cues in manufacturing accounts, that will bleed your marks dry too. Achieving 100% accuracy in your trial balance phase means rigorously avoiding these specific pitfalls. All right, let's step it up to the next level. Section 3, AO3 Interpretation.
Now, if you see a dramatic drop in a current ratio, say from a very healthy 2.5 to 1, crashing down to a risky 1.1 to 1, that requires serious investigation. Look, anyone can divide current assets by current liabilities. Calculating the ratio is just a baseline skill. But evaluating the underlying cause of that evaporating liquidity, that is what defines a true A-star response.
You really have to debate the cause and effect chain here. Why did liquidity drop so sharply? Senior examiner?
Well, perhaps it was a massive piece of capital expenditure. Maybe the company just bought a brand new factory.
Exactly. And the next AO3 question you have to ask is, how did they fund it?
Did they fund that machinery by issuing new ordinary shares that protects liquidity but dilutes ownership? Or did they take on risky debentures that are now draining their cash through mandatory interest payments? This whole domino effect of business decisions is exactly what you must investigate.
And keep in mind, differing accounting policies for something as routine as depreciation can complicate interfirm comparisons immensely.
Oh, absolutely. I mean, if Company A uses the straight line method and Company B uses the reducing balance method, their net book values are going to look entirely different, even if they bought the exact same machinery on the exact same day. This forces you to look past the surface numbers and critically judge the true quality of their reported profit.
Because ultimately, a balance sheet only tells you the history. It's the non-financial elements that tell you the future. Things that are completely invisible in the accounting records, like plummeting staff morale, a deteriorating retail location, or some scandal destroying their market reputation, those are absolutely vital to a business's long-term sustainability and its return on capital employed, or ROCE. Exactly. And too often, in coursework and AO3 exam questions, students get severe tunnel vision. They strictly focus on the math and completely forget these invisible factors. You have to step back and consider the holistic business reality.
Let's wrap things up with Section 4, Critical Examiner Insights. Senior Examiner. I am loudly warning candidates right now. Top-tier students are throwing away incredibly easy marks simply due to poor handwriting in their ledger accounts. Listen, if I cannot distinguish your balance BD from your balance CD, I literally cannot award you the mark. It is incredibly frustrating. You also need to lock down your time management and perfectly document your coursework evidence. Respect the weightage of each question. Do not, under any circumstances, spend 20 minutes on a simple 3-mark definition. Here's another one. Imagine a student treats a routine vehicle repair, which is a revenue expenditure, as the purchase of a new vehicle, which is a capital expenditure.
Oh, that is a massive red flag. That specific error will instantly collapse your entire financial logic. By capitalizing a repair, you artificially inflate your assets and falsely inflate your profit at the exact same time. It completely destroys the prudence concept we discussed earlier, and it shows a fundamental misunderstanding of basic accounting principles.
Subject Specialist. Well, we're going to leave you today with this final A-star challenge to really test your investigative skills. Pause and truly think about this. If a company's return on capital employed is steadily rising on paper, making them look highly profitable, but internally their staff morale is crashing and externally their market reputation is in tatters, is that business truly sustainable? Senior Examiner, how do those invisible, non-financial factors threaten to destroy a business that looks financially flawless on paper? Take that question, debate it, and let it fuel your mastery of IGCSE accounting. Thanks for listening.